Hello, my name is Antoine Bouveret. I'm a senior economist at the European Securities and Market Authority. First, I would like to thank Rob Engel and Dick Berner for inviting me to this conference. Unfortunately, I'm not able to be in New York City for obvious reasons, but I'll do my best to present my recent research on cyber risk. In this talk, I will look first at the estimation of losses due to cyber risk for financial institutions based on work done while I was at the IMF, and then I will outline some preliminary results on risk related to the use of cloud providers based on ongoing work with my colleague Alexander Harris from ESMA as well. As you can see on the first slide, the usual disclaimer applies. Thank you. Cyber risk has emerged as a topic of central importance for policymakers, regulators, and market participants. In that context, it's crucial to look at what models and quantitative analysis can do in order to provide some insight on what are the implications of cyber risk for firms and more broadly the financial system. This presentation will focus mainly on the financial sector, but the analysis could be expanded to cover the non-financial sector as well. First, to understand cyber risk, one needs to be able to assess what potential losses cyber attacks can entail. Second, financial institutions have been increasingly reliant on services offered by cloud providers, such as infrastructure as a service, which includes storage and virtualization, platform as a service, which enable users to develop applications, or software as a service. Using cloud providers offer efficiency benefits for users and the financial system as a whole. However, the cloud market is highly concentrated, which can create additional risk for users and for the financial system as a whole, that I will explore in the second part of this presentation. So first, let me start with an obvious question. Why should financial institutions care about cyber risk? One simple way to think of cyber risk is to look at the three different components of risk in general. One is threat, and one can argue that the financial sector is among the most targeted sectors in terms of cyber attacks. A lot of data sets show that, and also, I guess, if you're a cyber criminal, that's the type of sector you want to target first. Second, the financial sector is highly vulnerable. Why? Because it's particularly IT intensive, dependent on critical infrastructures. Think about central counterparties, settlement and payment systems, or cloud providers. The financial system is also highly interconnected. And finally, financial institutions, especially banks, might be highly vulnerable due to the use of legacy systems. Finally, consequences of cyber attacks can be very high for financial institutions, obviously through direct losses, but also through indirect and intangible losses. Loss of confidence for a bank leading to a bank run, for example. Finally, the occurrence of a cyber event in an institution can spill over to the rest of the financial system. For example, the outage of a trading venue would make market participants unable to trade securities on this particular venue. Let's look quickly at the different types of cyber attacks to put a framework that will be used in the rest of the analysis. One can use the CIA framework to look at them. So CIA means confidentiality, integrity, and availability. First, attacks can have an impact on confidentiality. The typical example here is a data breach, such as the one experienced by Equifax in 2017, where more than 145 million personal records were breached, leading to direct cost of at least $1.4 billion up to date, based on Equifax disclosures. Attacks can also impact the integrity of IT systems, where attackers can change the data in these systems. Cyber fraud can be to some extent included there, such as the one where hackers were able to use Bangladesh Central Bank SWIFT credentials to wire US dollars from the central bank account at the New York Fed to several bank accounts in Asia. Finally, attacks can make the system unavailable, as is the case during outages. This is typically the type of cyber attacks we think of when we think of cyber attacks and financial institutions. As an example, we can think of the NotPetya attack a few years ago that was conveyed in Ukraine through ransomware in a simple tax accounting software. And this ransomware resulted in important disruption of supply chain worldwide and large losses for several global firms across sectors, shipping, pharmaceutical, and construction companies, for example. Let's talk now about losses for financial institutions due to cyber risk. First question, how can we estimate losses due to cyber risk? One thing is that it's important to keep in mind the objective of this endeavor. It could be to raise awareness in and outside of the firm. Second, it could be a way to evaluate the purchase of cyber insurance. And finally, estimation of losses can be useful in the broader context of enterprise risk management. Actuarial science provides a set of methods to look at aggregate losses stemming from a variety of sources. Think of earthquakes or hurricane and any type of natural disaster, for example. The idea there is to estimate the distribution of aggregated losses over millions of simulations in order to derive expected losses along with their distribution. To perform this analysis, one needs data on the frequency of successful cyber attacks, as well as data on losses due to cyber attacks. For further details, I've put a couple of references there, and there are also additional references at the end of this presentation. Let's take an example. The top left panel there shows the distribution of cyber events. During each time period, let's say every year, a given number of cyber attacks will occur. In this example, I assume that the frequency of cyber attacks follows a Poisson distribution, but other distribution can be used as well. So the top left shows the distribution of those cyber events over time. Let's say that in a given year we have 1,000 events. The next step is to estimate for each of these events what are the losses. The top right chart shows the distribution of losses due to cyber events. As you can see, most events lead to small losses. You can see that with a very high frequency on the left, but there are a few events that can produce very large losses, as shown by the tail of this distribution. For each of the 1,000 events, one draws randomly the corresponding losses in this distribution and sum them up over each year. Finally, the bottom chart shows the aggregated distribution of field losses. If you run, say, 1 million simulations, and for each of the simulations you estimate the losses and then look at the distribution of the losses for each year, this is what you get. From this distribution of aggregated losses, we can derive several important risk indicators, such as the value at risk, the maximum amount that a firm will lose over a year at a given probability, or the expected shortfall, which represent the average losses above the value at risk. As I said earlier, to estimate the losses, we actually need data on cyber events. One can use internal or external databases. Operational risk databases are particularly useful as they provide large data sets on operational risk events for the financial sector. One challenge is that these databases do not usually focus on cyber risk, although there has been some improvement over the last few years. In this analysis, I used two different data sets. I used the Advisen dataset to calibrate the frequency of cyber attacks for the financial sector, and I used the ORX News dataset, which provide details on cyber events based on publicly available information. One needs to say that the sample is actually quite small, with around 340 events, and only 100 events have actual loss data, and in those cases, the losses only refer to direct losses. The map below shows the distribution by country, and you can see that a large share of events are related to US financial institutions. The good thing is that over time, larger data sets should become available to researchers and institutions, and it's key to make sure that the data are collected in a consistent manner. As I said earlier, there are different modeling approaches that can be taken. In this application, assume that the frequency of cyber attacks follows the Poisson distribution, with a parameter lambda, which is equal to the average number of cyber events per year computed over 2011-2018. Which is quite close to 1,000. For the distribution of losses, assume a splice distribution. Most losses are assumed to follow log normal distribution, that's the body, but also assume that large losses are possible, and they are modeled by the tail of the distribution, which is based on a generalized Pareto distribution. In practice, it means that most losses will be relatively small, but it's possible to have systemic losses due to cyber risk, even though we do not observe such large losses in the dataset. Finally, contagion is introduced in the model. Cyber events remain independent. However, when one cyber event occurs, there's a given probability that one or more firms will also suffer losses due to the same event. In that case, the parameter is calibrated on ORX data and is equal to 20%. So for each event, there's a 20% probability that one or more firms will be impacted. The estimation of the distribution of aggregated losses is then obtained by using 1 million of simulation. This table shows the main result under a baseline scenario where the frequency of attacks is approximately equal to 1,000 events per year, and one severe scenario when the number of attacks is equal to 2 times the maximum number of attacks in the sample. So overall, it's around 2.8 thousand events. In both scenarios, we allow for contagion. Overall, the results show that average losses could be quite large. It's around 100 billion per year in the baseline scenario and up to 350 billion in the severe scenario with Contagion. To put those numbers in perspective, I gathered data on worldwide bank net income for 2016. And so the average losses in the baseline scenario represent around 9% of bank net income, whereas in the severe scenario, it's up to 1/3 of worldwide bank net income in 2016. More importantly, risk measures such as the value at risk and the expected shortfall are 2 to 3 times the average losses due to the possibility of large losses represented by the GPD. The bottom line is that cyber losses can be very large for the financial system as a whole, but also for a single financial institution. In that context, there had been discussion on risks related to critical infrastructure for the financial system, such as CCPs, payment and settlement system, or more recently cloud providers, that we'll cover in the next few slides. Let's take a closer look at risk related to the use of cloud providers by financial institutions. Over the last few years, there's been a general trend in moving from on-premises data centers to cloud services. For example, the top chart shows the share of businesses using cloud computing services in Japan based on OECD data. One can see a clear trend. In that context, more than 80% of financial institutions use cloud services in Japan, against 60% for all sectors. Similar trends have been documented by the Financial Stability Board as well, based on surveys among close to 300 financial institutions. It's important to note that cloud services provide a number of benefits to users, such as scalability, flexibility, and cloud providers can also improve the resilience of financial institutions since they invest massively on security. At the same time, the market is characterized by a high degree of concentration, as shown in the bottom chart. The top 4 cloud providers account for more than 70% of revenue. As we know, that a high degree of concentration can create risks, as multiple financial institutions are likely to use the same cloud providers. It implies that if the providers were to suffer an outage, multiple institutions would be affected. In that context, let me present some preliminary results based on our ongoing work with Alex. I'll use a simple model to analyze 3 different issues. First, do cloud providers reduce the risk of outages for firms using their services? Second, under which condition could cloud providers increase risk to financial stability? And finally, how can we mitigate risk to financial stability? As I said earlier, this is really work in progress, so Alex and I welcome any comments or remark you could have based on this presentation. And as I said earlier, our email are at the end of this PowerPoint presentation. Let me introduce the main features of the model. So in our model, financial sector's firms choose whether to outsource to the cloud or not. This is of course a very stylized and general. It does not describe precisely what type of services is being outsourced or give details on the type of financial sector firm. We may develop more detailed examples to illustrate the models in different settings. Anyway, the use of cloud services enables firms to be more resilient. When using cloud providers, firms have a lower probability of suffering an outage, represented by lambda, and when they have an outage, the duration of the outage will be shorter than when using on-premises data center. So that's the mu. If there's a cloud outage, there's a probability Q that all firms relying on the cloud suffer an outage as well, for the duration that the cloud providers remains in outage. Finally, firms decide to use cloud providers based on the cost-benefit analysis. They compare the cost of using providers, the fee paid, to the expected cost of outages. In addition, we assume cost externalities. If a large number of firms suffer an outage at the same time, systemic costs arise. For example, if a bank suffers an outage for a few hours, that will create some temporary issues in the financial system, but it will work okay. But if several banks suffer an outage at the same time, then the cost will be disproportionately higher due to self-reinforcing effects within the financial system. So that's what is represented by those systemic costs. Our main theoretical results are as follows. Firstly, given the cost and fees I just described, there's a unique equilibrium in which all firms use cloud. If there's a single cloud provider, they will set the fee to make firms indifferent between outsourcing and not, and thereby capture all the economic surplus from the transaction. In the unique equilibrium, all firms outsource and the monopoly provider extract an economic rent. Competition effects are not really the focus of our research, but we know that competition is another consideration for policymakers and tends to point in the same direction as concerns around systemic risk. The main result we have is intuitive. Cloud providers can increase systemic risk as a result of concentration risk. Although overall time spent in outage is lower for outsourced firms, they are more likely to suffer outages at the same time. We express this result formally using the inequality on the slide, which compares a scenario with a single monopolist cloud providers against a no-cloud scenario. On the left-hand side, we have the difference in systemic cost between the two scenarios. Gamma is the systemic cost, which scales with the number of firms. Beta minus alpha is the increased risk of a systemic event due to cloud outsourcing. Remember that when you have a cloud outage, you have several firms being impacted at the same time, whereas when firms don't use the cloud, the probability of simultaneous firms facing outage is very low. On the right-hand side, we have the difference in individual firms' cloud cost. So the single cloud provider increases expected cost if market-level externalities, the left-hand side, outweigh firm-level efficiency savings, the right-hand side. Finally, we look at what happens if, instead of a single provider, there may be several cloud providers. As you would expect, systemic risk is mitigated when there is more than one provider. We can now come back to the three initial questions raised earlier and see how the model can yield some important results. First, cloud providers reduce the risk of outages at individual firm level because they are more efficient, they are more secure. Hence, all firms have an incentive to use cloud. Second, if systemic costs are higher and the likelihood of simultaneous outages is high as well, then the use of cloud providers can raise risks to financial stability. How can we mitigate these risks? There are several ways. One option is to reduce the probability of simultaneous outages. This could be done at the cloud provider level by increasing its resilience. Diversification is another option. By making sure that firms use different cloud providers, this reduces the impact of a cloud outage on the financial system. Another option is to foster data portability and interoperability so that when a cloud provider suffers an outage, firms can quickly use the services of other providers. Looking forward, we plan on calibrating our model to assess the systemic cost that we presented earlier. To some extent, the simple model presented above can also be used to think of data that would be needed to test the proposition presented previously. Given the scarcity of data, it remains challenging to calibrate such a model, and we welcome any suggestion of data sources or modeling options. Let me conclude with some key messages. First, cyber risk can have a significant impact at entity and system levels, which calls for further work on modeling and estimation of costs. The modeling framework outlined in this presentation is a first step in estimating more rigorously cyber losses. As such, organizing events combining market participants, academic and cloud service provider is key to enhance our understanding of cyber risk. And of course, one of such events is the actual conference organized by the Volatility and Risk Institute. Then, the important role of cloud provider needs to be studied further. Cloud services once again provide significant benefits to firms and the financial system as a whole, but concentration risk needs to be addressed. In that context, we've put forward a range of options that policymakers could consider. So we'll stop there. Thank you for your attention, and please, in the next slide, you have our contact email, so we look forward to any comment or remark or question. Thank you so much. Goodbye.